Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for ChartsandMarkets.com. Welcome back to the show, Bob.
Good morning on Friday, and it's a very pleasant day, so here we are.
Bob, we'll start off the show with a couple of listener questions. Our first question is from Cecil. Would you be buying gold or silver now in early September after this big run-up, or should people wait to buy more?
Oh, yeah, good question. It turned out to be a really strong rally. Of course, the work I do is mainly on the stocks, the gold stocks, because I think that's the place to be. And our buy last year was November the 1st, and it was accumulate on weakness. And there was a little sell-off into November. And there's been a very good rally if you look at the GDXJ. And then a number of weeks ago it began to get overbought, so our advice was kind of lighten up a little in the sector. And just when we noticed that some of the gold and silver bugs are saying, this is it, you gotta buy, even though prices were high. So the sector has become overbought. And I'm sure that if we have a financial problem this fall, the stocks go in the sector, precious metals will get down to oversold. So it's a good question, and the appropriate thing would be to take a little money off the table and then look to accumulate a gain on disappointment, probably into November, maybe, just sort of guessing, but we'll be applying our technicals as we get to that time. And then there's another question.
Yes, from Joe, who says, gabillion thanks for taking his question last week.
A gazillion thanks.
Yes.
That's a new one, isn't it? Yeah.
Yes, it is.
And
so Joe's question, rather lengthy, but here we go. Bob says he expects a major event this fall, which will cause a meaningful gold correction, a waterfall in silver, a mining stock slaughterhouse, his language is rather colorful, and a fabulous buying opportunity in Bob's favorite instruments, the warrants. That such an event can be explained by forced liquidations whereby margin clerks become king for a few days, and also because liquidity needs to be raised from well-performing assets to cover those that are going down, presumably the general stock market. What's the whole deal behind that?
Well, Joe has he's an experienced investor, trader, so, and the questions are appropriate. Now, the most appealing part for those of us who like the gold sector is that there's a probable many-year, multi-year, maybe even a decade and a half bull market ahead of us. But the thing that sets up the bull market is the post-bubble contraction, of which the first thing will be a sell-off. Gosh, it's been terrific. We'd looked for stocks to rally out of dismal December right out to about mid-year, and things became overbought and getting overbought, and then August, and we'd looked for the twilight zone, and there was a pretty good hit in the financial markets. And then my secret wish was that hopefully we could get a rally into the first part of September, and this is what we're getting here. This week, the last few days, there's the trade talks with China are going well, and employment numbers. They may be confusing, but the street sort of took them as positive. And you've had really good action in silver and platinum. And this, of course, gets us onto it, is that when you've had a rally in precious metals, silver will always outperform gold. And so all you do is take the silver-gold ratio, and there's a technical thing called the RSI, which is a measure of momentum. And it's on the silver-gold ratio up to 85, and anything above 80 we consider as the market's got a lot of risk in it. And if it gets above 86, then it's sort of in dangerous territory. And the last time it got up very high was in April of 2011, which was when that mania in precious metals climaxed, and the RSI on the silver-gold ratio got up to 92, which we discussed at the time, and also pointed out that that was really dangerous because the only other time that RSI got up to 92 was in January of 1980 when silver was up to 48 and all that sort of stuff. So that was that huge Hunt Brothers promotion that the gold-silver ratio had to be at 16, and they briefly got it down to 16. And then, of course, in the it was late 90s, there was a banking crisis, and the ratio was up to 90. And more lately, it's around 90, and it could go, on the next crisis, it could go to, who knows, just a guess, Jim, maybe 120. The gold-silver ratio, silver bugs thought that it should go back to the 16 ratio that prevailed through the 1600s and 1700s, and why they decided that, I don't know. But at any rate, this is a multi-point question. We appreciate it from Joe, and I think we answered it. But again, the opportunity is not yet here in the sector, but it takes a crisis to set up the long bull market for gold. So there'll be another opportunity to accumulate gold stocks on weakness. So, not that I'm looking forward to it, but we always look forward to trading opportunities in the market, either overbought or oversold, and the tools we have been quite reliable.
We'll have a second question from our friend Joe when we return with Bob Hoye.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Bob Hoye. Bob, Joe asked, since Bob expects a 20-year precious metals bull, does that mean he also expects a 20-year government bond bear market?
Yeah, no, well, no, not governments. Well, lower grade governments, yeah, but treasuries, long treasuries, the U.S. and the senior currency, they could get whacked in price with yields going up on a crisis, and really the bullishness in the U.S. Treasuries is incredible. Strongest seen since June of 2016, when it was the same story. Hey, they're going to drive the yields down to zero, U.S. yields, and that was the story then. And at that point, the German long yield got down to 0.44%. And in the disaster, the hit then, it went up to 140. So it was a huge swing in yield. This time, the yields in Europe are down into minus, minus 0.80, minus 0.90, which is absurd. But we think it's the same thing. The technical analysis on the U.S. market, which is what we did in June of 2016, said that the U.S. market was still open enough, whereas the fact that you're down to zero or minus yields in Europe is due to a one-way market where the central bank has been buying so much, it's distorted things. And the market is not as distorted in the U.S., so it's then subject to its own excesses. And the excesses are quite impressive, and that's in the bond future, which is Treasuries. It's also excessive in the municipal bonds, which trade pretty close to Treasuries, and also high-grade corporate bonds, the LQD, are way up there. Hey, this is very frothy stuff. So, it can correct. And then also, Joe's got a question here about margin clerks that I kind of liked. He says that such an event can be explained by forced liquidations whereby margin clerks become king for a few days. And also, that's the key thing. What you have now for veterans in the financial markets is that the central bankers have gone full reckless, and they're trying to get the accounts all leveraged up. And while it's never written in the job description of a central banker, it's understood. And what you have also within the banking and brokerage business is the margin clerk or the equivalent. And the margin clerk's job description is 180 degrees different to the central banker. There's a repeat that the central banker wants to get the accounts out of line, and the margin clerk, his job description is to get the accounts in line. So the reason why you do have a liquidity crisis is that the power shifts from the central bankers over to the margin clerks. And it's there. You can take a look at it just ever since the Federal Reserve was started in 1913. You can see all the bull and bear markets, and on each of the sharp bear markets is when the margin clerks overwhelmed the central bankers. So, good questions.
We'll have more with Bob Hoye right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, the Chinese bank ratio is at its lowest level since 2007. What is a bank ratio, and should we be concerned?
Well, yeah, I think what they're talking about is the amount of reserves they've got relative to their loans, and they're all loaned out, which is what bankers do in a mania. And then this is where the Austrian school, the von Mises guys, really did some work on the credit cycle. And Mises pointed out that at the top of a boom, for the contraction, you don't have to have the bankers calling loans. All that has to happen is they get a little concerned and stop making them. But that's one way of looking at it. The other way we look at it is just to measure the excesses in the hot items. They're up there and very speculative. And also to look at the history, and you know that there are two warnings come in on a boom, and one of them is when the Treasury bill rate turns down, and the 3-month in the U.S. went up until March, and so long as it was going up, it was saying the boom is on. And when it turns down, and turns down seriously such as it has, then it says that the boom is probably over. But then that then forced the Federal Reserve to cut interest rates when, and the Wall Streeters couldn't figure that out because they said, oh my gosh, tremendous employment figures, high stock market, and the boom is on. Why would they ever lower interest rates? And our point was that as the T-bill rate was coming down, and pointed out that the Fed would have to cut the administered rate in order to look like it's in charge of the decline, which they did. We didn't think they'd cut it until September, but hey, they did cut it in August, and then what you have now is the enthusiastic but naive buying on the Fed cut. And so you want to know what happens there, just look at history. And the last first Fed cut, they were talking it up in September 2007, and that it was the Fed cut would be wonderful, and it would certainly drive the stock market up. And that was the quote, one quote I had. I think that was the middle of September, and the stock market peaked in the middle of October. But so the people who have been buying on the Fed cut have been buying enthusiastically for the wrong reason. And again, you look at interest rates, short rates, they go up with the boom and down with the bust. So you have this irony that the fastest declines in the Fed rate have occurred during the worst parts of a bear market. So these guys are working on theory, and I think some of those theories have never been founded on empirical evidence, and got it back for a couple 100 years that interest rates go up with the boom and down in the contraction. So it's fascinating. But also, I think there was another one here where, this one was just the other day, September 4th, where the new president of the New York Fed, and that's the really important chapter, he says, quote, low inflation is the problem of this era. So we all know that they've been trying to get inflation above 2% annual, and they think that if it's not up there, something awful's going to happen. Yeah, they're right. There's some deflation ahead. But this was the same problem in the 1920s. You had a huge boom in commodities that blew out in 1920, and then the crash in commodities was a real horror show. And then the guys at the Fed get all focused on weak pricing power, as they used to call it then, and were easy with the monetary switches through the 1920s, kept worrying that prices weren't strong enough, and did not understand inflation and financial assets. So, and this is the same thing, and he, as I said just the other day, he's saying that low inflation is the problem of this era, and he doesn't understand that the inflation has been in financial assets, stocks and bonds, to the moon. So, of course, inflation in financial assets is not seen as a problem now, mainly because they don't understand it. But it will be the problem is when inflated stock and inflated bond prices come down. And they will, because of the old saying, trees don't grow to the sky. And we have measurable excesses on stocks and bonds, particularly bonds in the last week or so. So, and then the other thing with bonds is in the Treasuries, you have a seasonal trade in here where typically you can have a good high for bond prices in late August or in late September. Well, this is where we are, So this fall is going to be very interesting, and I think it'll be interesting to see how the president of the New York Fed eventually learns about the problems of inflation and financial assets when he's been worrying about that commodity prices are not inflating. So very, very limited research there at these central banks. They've got, who knows, the Fed, I remember it was maybe 20 years ago, I looked at how many economists the Federal Reserve had working for the whole thing, and it was around 300 then. And who knows how many now. And yet, none of them, well, they know very little about inflation and financial assets, and they're still worrying that there's not enough inflation in commodities. But they're right on that, because industrial commodities have been rallied up until around April, and copper came down quite a bit. Other base metals have weakened, and then more recently crude oil is weakening. And we always note that for some of these industrial commodities, they can set reliably seasonal lows towards the end of the year, and that's what created dismal December. And you remember that we had on December 26th a sequential buy on the S&P and a sequential buy on crude oil, both at the same time, and that's where we felt confident that we would get a good rally out till the middle of the year. So let's put it this way, Jim. Financial history is working as it should, and it's on the path to a contraction. And the other thing is that central bankers have been doing exactly the same thing they did in the 1920s. So it is, let's call it another train wreck.
Well, Albert Einstein said his definition of insanity was doing the same thing over and over again, expecting different results. I guess that would be our central bankers.
Yes, and then also you can put forward a pretty good argument or paper on how the risks here now, and people will say, oh, yeah, but this time it's different. So there's huge price pumped into the markets, price risk pumped into the markets, but this time it's different because it's going to, it's not, risk is not risk. So I think we're going to have a lot of discovery being made over the next 6 to 8 weeks, and we want to make sure that our subscribers are on the right side of financial history.
Bob, thank you so much for being on the show.
Well, it's good to be with you, Jim, and with our listeners, and look forward to next Friday.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, like our friend Joe did, you can send them to info@howestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.